Good morning to all of those who have joined. This is Tom Hulick, the CEO of Strategy Asset Managers. We will begin shortly. Gary, thanks for controlling the waiting room. I appreciate that. Okay, it's 11:01. We are going to begin our update. The obvious reason why we're getting onto the call today is to update our clients and our partners about the Silicon Valley Bank collapse and its impact on the markets and the economy and what it means for your portfolio. Joe Traba, Senior Portfolio Manager, Alex Hagstrom, our CFA and Portfolio Manager, and I will try to go through and answer as many questions as have been given to us to reassure you of the current situation with Strategy Asset Managers, Schwab, Silicon Valley Bank, and what it means for you. First off, I'd like to just say thank you for everybody to participate today. There's been a lot of information that has come through since Friday and the collapse of Silicon Valley Bank and the intervention with the government and also the federal banking committees. What you need to know is that Sam and your portfolios did not have any direct exposure to the regional banks. We own one position, that's JP Morgan, and Joe and Alex will talk specifically about that. The deposits at Silicon Valley Bank and Signature Bank, and even the stress that happened at First Republic Bank, were reassured over the weekend. The depositors were reassured over the weekend by the government that they would be made whole. At what point we didn't know until about Sunday when Janet Yellen came out and said that we should have everything clear by Monday. And that has taken place. So that was very reassuring from Janet Yellen, the Treasury Secretary. The other point is we don't think that this is systemic, nor is it 2008 with the great financial crisis. So we will talk a little bit about that. We're going to go through the FDIC and the difference between SIPC. That should make you more informed about what you're probably hearing from multiple sources. And then we're going to talk about herd mentality, the panic, or is this an opportunity? But by the end of the call, you should feel a little bit more informed about the current situation and where we stand and the strength of the banking system in the United States, as well as the backstop of the federal government, which after the original great financial crisis, we've gone in and improved quite a bit. Joe, I'm going to turn it over to you to start out.
And I think before we go on, it's important to know what happened before. And this is with Silicon Valley Bank. Now, this isn't a traditional bank. They are very tied to a lot of the venture capital that is tied to startups. Why that's important? Because that's where their concentration was. They had a high correlation to startups and the hedge funds. And as we are well aware of, that business a few years ago did extremely well. Excuse me. And their assets ballooned from 50 billion to over 200 billion in a couple of years. Fast forward to what we saw recently, and it was really the end of last year that you started to see their assets weren't growing. And a lot of these non-profitable technology firms had to get more money from their venture capital. Also think of Bitcoin. Bitcoin had a huge drop. That had a direct correlation to the bank. Now, the bank, what they owned was long-dated U.S. Treasuries. And when you get a run on a bank, they had $45 billion withdrawn in a couple of days. This forced the bank to either raise capital or to find a suitor, because they had to then sell their treasuries, which were at a loss. How the bank works, as long as they hold them to maturity, they never have to mark to market. So when they realized these losses on U.S. Treasuries, this created more, like Tom said, panic within the large institutions that pooled their money. That's why they were shut down on Friday. And again, over the weekend, and this is typically what happened, they came and said they were going to affirm both the insured and also the uninsured portions of people's deposits. We know on Monday, later in the afternoon, people did have access to their capital, their deposits, and they were able to go ahead and access that. So again, you look at the order flow, what happened, why it happened, and where do we stand now? It's important to know that, again, our banking system is extremely strong. This wasn't caused by assets that had a value to it. Kind of think of 2008 with mortgages. They owned US Treasuries. It's the regulation, and it was more on the management. It was mismanagement where they did not properly hedge. And they did not, again, they were gathering assets when interest rates really started to go lower. Interest rates started to go higher. The price of the bonds went lower. So for me, that was just a mismanagement on what management did. And when that happens, obviously people are going to have some panic, and they didn't properly communicate with some of their larger hedge funds that had tied up in the bank as well. It's kind of a trust with the partners, and that definitely, when people are nervous about their income, they're going to pull their assets. What did that do? Well, over the weekend, again, we saw this a little bit yesterday. You want to see what the effect was. Did that actually happen? That they were able to get access to deposits? Yes. And now you're seeing people really unsure about a lot of these regional banks and going to the larger banks. So this may not be a direct result of what they wanted to happen, but this is what's happened. And again, for the overall banking system, this is not 2008, and we'll go into that a little bit more. This was, again, isolated events with a couple of banks that, again, you had a run on a bank. They don't have enough capital available and aren't properly leveraged. This is what happens. It's also worth noting what the regulators did. They also increased capital for any of the regional banks. So they're on top of having bailing them out. They also said any other bank that needs capital, they will provide that capital based on their treasuries. So they did twofold. One, they did come and rescue these banks and all depositors made whole, but they also gave another lifeline. And that's doubly important because what they did not do was bail out the banks. So equity holders are going to not have any value. That bank was at 200, then down to 100 and closed trading. So it'll probably open up. And again, unless someone comes in at the last minute to save the bank, we'd expect the equity to be at zero. Same thing with Signature Bank. The debt, that's an interesting story. It's probably priced around 45 cents on the dollar. So they are showing a value of the bank. We go into that because, again, this is a direct consequence of the sell-off in unprofitable tech and the Bitcoin rise. I like to kind of think of it as Kathy Wood and ARK, that ETF everyone was saying went up hundreds of percents. Well, then it crashed. And it's also some of the Bitcoin currency. When you have this environment, you have the ebbs and flows. You had a tremendous rise up. And for those companies that were smart with their fundamentals and balance sheets, they were able to lock in really low interest rates. For other companies that continued to be leveraged, they had a big cash call pool. And I think we're going to continue to see this. And for us, you really have to think about just the market cycle. You're allowed to make as much money as a publicly traded company, but you should also be allowed to lose. And that means going bankrupt for bad decisions. You look back the last couple of years, the Fed really bank stopped everyone, meaning both people and companies had access to capital. That's drying up. I would expect to see more bank regulation, which in turn means lending should be a little bit more stricter. And that in turn will slow down inflation. We think inflation slowing, that then gives the Fed really reasons to slow down. And maybe we've seen the peak in interest rates. So those were some of the concerns we did see heading into this year. And again, expecting earnings to slow, which we're seeing. But again, as you get through this, you just have to know where you're at in the cycle. And again, for us, it's really important to know what you own. And that's what we emphasize with all of our clients and partners. We know what we own. We know what we own with you. If you want us to take a second look at other assets that you have, we're more than willing to do that.
Joe, let's have Alex give an overview of the SIPC and FDIC issue.
Absolutely. So yeah, as Tom mentioned, there's a lot of protection for the separately managed accounts that you own. Per the SEC, all of the stocks, bonds, mutual funds, any security in your account is segregated, and your segregated assets are not available to a brokerage's creditors. You know, those stocks and bonds and funds belong to you. Even if your broker went bankrupt tomorrow, those stocks and bonds and funds would still belong to you. In addition to that, there's a second layer of protection. It's called SIPC insurance. It protects your account for any amount up to $500,000, including up to $250,000 of cash. Plus, brokers like Schwab even have a third layer of protection. In their case, they have an insurance policy from Lloyd's of London. So, you know, overall, the securities in your brokerage accounts are extremely well protected from broker insolvency. If that were to happen, which, we do not foresee for, a well-capitalized brokerage like Schwab.
Alex, let me ask you a question. On Friday, when we got the information about Silicon Valley Bank and Moody's was making the move to downgrade the debt, we stayed late both Friday and Saturday and over the weekends, and we reviewed all investors' accounts for cash positions. Let's talk a little bit about that and what we were doing from a risk management standpoint, and what other firms also were doing for risk management in looking at their clients' cash.
Yeah, absolutely. So, we go through and we look, we're making sure that our clients don't have cash above that $250,000 SIPC limit. The good thing is if you put money into a money market fund or a treasury, that does not count as cash. So those assets are segregated. They belong to you. They're not at risk in any insolvency, but we are very conscious of that $250,000 cash limit.
And so are the advisors that are on this call as well. We had calls with advisors all the way through the weekend and through yesterday about the risk management steps that were in place to ensure that there was a safety of capital in the accounts, especially at Strategy Asset Managers, but with our partners out there. Thank you, Alex, about that. Joe, did you want to go into the next discussion?
Yeah, just and one more point on the treasuries. We actually did buy treasuries really starting the end of last year. So not that we were foreseeing this, it just we stay with high quality. And I think that's important. We didn't go to unrealistic yields. We, again, stick with what the market's pricing and found the best assets to increase our quality. And again, that kind of didn't have to worry about the volatility. And I think that's how this year is going to play out. The next point I wanted to mention, and this is what Tom had alluded to, why is this not 2008? And anyone out there, if you remember, 2008 was really because you weren't able to value assets. And again, this affected balance sheets of any of the banks. And what we're seeing now, it's US Treasuries. Again, we know both of these banks, they owned US Treasuries. It was just the mark to market. What that means is, as long as the banks hold these treasuries, they never have to show that the bond prices went lower as the Fed was raising interest rates. They had to do that when they had to sell it. And that created, again, more uncertainty. So the heart of the issue was, again, raising interest rate and treasuries, and for us, the mismanagement of the companies. Very different than what we saw in 2008. And we also have to remember, banks going under, unfortunately, is part of our history. You can look back at 2020. We had a few banks go under then. And obviously, everyone remembers the 2008. And you can even, those of you that are a little bit older, remember the savings and loans when we had almost 30% of the banks wiped out. So this does happen. What does it do? We end up shoring up our balance sheets, our regulation, and we do end up coming out stronger from this. And I think that's where we're at. With this, you can kind of look back and go, was this our, Nr1 and WorldCom moment? That completely different. But again, if you're going to circle a couple of companies that mismanagement, you can look at what happened now. The other thing, does history often repeat itself? No, but it does rhyme. And that's, again, another part of what we look at with tightening cycles and the direct result that it has on some of the booms. And if you remember Volcker, this is in 79 and 1981, you had a huge boom prior in oil and gas. And then as we started tightening, you saw these LPs and a lot of these energy limited partnerships really seize as they were highly leveraged. And the higher interest rates obviously hurt borrowing costs. So again, this does happen. It's different cycles that you see a boom and bust. But again, we do get through this, and we all will get through this.
Joe, let's talk a little bit about what all clients, institutional and private clients, need to know. I mentioned earlier that our portfolios did not have any direct exposure to the regional banks, which was great. Some people out there may have some exposure, but the stability of the U.S. banking system today is far different than it was in the past. Much more stable, stronger. We learned a lot. And there's risk management in place. So we feel good about this, about our position as a firm, and our custodians, as well as our partners, should also feel good about that. Is this systemic to any of the stocks that we hold in the portfolio? And I know the answer is probably not.
Yeah, I mean, when you really have to look at what does systemic mean, and it's the counter risk. So if you remember in 2008, it's the counter risk of other banks or other companies that you weren't able to sell certain types of instruments. That's not happening now at all. The credit market and also, the fixed income markets, they're open and everything is healthy. So we're not seeing any, again, counter risk. When we look at the insurance companies as well, things are able to get priced. Trading is happening. And in fact, trading is, the last couple of days has been extremely robust. And again, we've seen trading carry on. So I don't see any of that risk coming through now. But I do want to mention 2 points. It's one, companies that were highly leveraged are going to have to address capital needs. If they weren't able to pay that debt, it's a higher interest rate. And that, does not portend well for these types of companies. So this can happen. And again, it shouldn't be unexpected. We said this at the end of last year. We would expect to see some companies that were weaker players and that we would start to see some bankruptcies. We had mentioned maybe like a Bed Bath & Beyond. And again, this is just part of the economic cycle. Companies that are well managed and can change direction, they will continue to do well and get through these periods. And companies that weren't able to change, and again, are seeing decrease in sales. This is how a free economy works. Those companies will go under. So I do think, you'll continue to see that. And that's why we stay and stick to high quality companies.
Okay.
Cash flow.
Yep. Alex, do you have anything to add to that before?
Yeah, and I think, this is part of how you crush inflation, right? You crush inflation by making interest rates high. You get, those weak companies out of the market. And that's, that's how it's done. And if, the price of bringing inflation down to a normal level is for weak companies, like mismanaged companies like Silicon Valley Bank, to be in trouble, that's a worthy price to pay so that well-managed companies like the ones we own can, continue to thrive in a normalized inflationary environment.
Strategy Asset Managers reviews technical information as well as, the qualitative information for our proprietary research. And we should talk a little bit about the technical levels just to let the clients know that we have access to this and what we've seen.
Yeah, it's a really interesting, again, technicals take the emotion out. And if we look historically, the 2 months that we see what we call noise are March and October. And as on cue, March has been one of those years where we have a lot of what we call noise, just a lot of things happening that's creating uncertainty. What happens? You typically get through this March time period. And when we look at two different levels of technicals, it is pointing toward, a better picture emerging. Can't tell you when, but again, once you know some of these unknowns, you can then manage through this kind of crisis.
Why is that important, though, Joe? Because in taking a look at the stress that's out there, when we take a look at technicals, that's just one area that we can use to make decisions, for our clients' accounts.
Yeah, and again, one of the things that we continue to reiterate, a lot of people, oh, I heard this on social media, I heard this on this television show, and that's what we're referring to is that herd mentality. When everyone's saying the same thing, are they doing their work? Are they looking at research? What research are they looking at? And I think that's, for us, extremely critical. So using different types of information, again, real information, the technicals do tell us, better days are ahead. And again, this is made contrary to what you hear on a lot of these TV shows, which I think is important because, again, what is a TV show supposed to do? They want to create, panic and fear so that they can get more viewers. Telling people things, may not what they want to hear, and you have some time here. That's not going to sell advertising.
Right.
So again, just know where we're at in the cycle, and again, stick to your game plan in this time period. You can always look at panic selling or making decisions when you're stressed. Typically isn't a good time to do it.
Alex, do you have anything to add on that before we conclude?
Yeah, just that, with how much rates have increased, it is absolutely essential that you own, companies that are specifically capable of surviving and doing well in that sort of environment. You don't want to just own every company, because if you do, you're going to have some bad apples like Silicon Valley who were not at all prepared for this, who just speculated on rates being zero forever. And now they're in big trouble.
Yeah. Okay. I think what we want to do is keep these calls short. Just reassure clients that that there's no direct exposure that we had in the portfolios to Silicon Valley Bank. That the liquidity is not an issue with us nor with any other institution at this point. There's not a loss of confidence in the banking system out there. The government did what they needed to do to step in to reassure investors and depositors that everything was going to be okay, and they did it in a very orderly fashion. To know that we do have a very strong banking system. We've got a very stable government. We have transparency with accounting. We have a legal system and checks and balances in place, and that worked very well during this unfortunate crisis. If you have any questions, you can contact us directly or contact your advisor directly, and we'd be happy to have a private conversation with you. Offline. We're going to have another call this afternoon at 2 p.m. It's once again, we're getting a lot of information that's coming through, and so it's fluid. So we'll have updated information later today, and then we're going to have some follow-up calls. Joe, do you want to say anything in conclusion?
Yeah, and again, if you have any questions or you want us to review a portfolio or you have cash at a bank, we can help you with that. And this is what we've been doing. So feel free to reach out to us.
Yeah, I'll make one point that was important that I forgot to bring up. We had somebody call in a panic on Friday from a nonprofit, and they were in a tough spot. And we were able to counsel them all the way through the weekend in support of the board that they had. This goes to all clients and all participants on the call. It doesn't matter whether you're an institutional partner of ours or you're a direct client. We're there to provide you with the facts, and the facts that we know are a lot different than what you will hear in the media. And that's important. You want to have somebody with a steady hand and who can lead you through a time like this. Anything else, Joe, before we sign off?
That's it.
All right. We will have another call at 2 p.m. today. If you'd like to chime into that, please dial in. Same dial-in information that you had. And then we have a subsequent follow-up call tomorrow, and then one summary call on Friday. And it seems that things are stabilizing and improving. And we hope to have much better information on Friday for everybody. Have a good afternoon.